Hey, welcome to the Grab the Map podcast, where we don't just look at it, we grab the map. I'm your host, John Crutchfield, and today I've got Denis Shapiro on the line, or I guess if you're watching this somewhere, you can see us in person. You can find this podcast pretty much anywhere that you listen to podcasts, but we're also on YouTube. So go ahead and take a look at us over there. I love the people that are sending us messages every week. Don't forget, you can always send us messages at grabthemap@gmail.com. I answer every single email personally. So if you send us an email there, I'd be glad to make a connection with you. Hey, Denis, are you there?
I'm here. Thank you so much for having me on.
Man, I'm glad you were able to jump on this morning. I noticed that you've got a book out on Amazon with multiple 4+ star reviews. And so I was excited to get to talk to you today, and I'm excited to share you with the people who listen to our podcast. It's called the Alternative Investment Almanac. Is that right?
Yep, the Alternative Investment Almanac. Basically, I just wanted to write a book about the different investments I was doing as a limited partner in a lot of different syndications. So everything from ATM machines to life insurance, but the core focus is commercial real estate. So everything from regular multifamily to self-storages to mobile home parks. I kind of just wanted to include it in one book so that if someone wanted to just get a quick snapshot of that asset class without having to read 400 pages to see if that asset class is something they would be more interested in potentially investing in. It's a great book for that purpose.
So getting straight to the point is always a great thing. So let's get straight to the point. A lot of our listeners are people that are trying to build real estate portfolios. They're already building real estate portfolios. Maybe they're also doing some flips or small multifamily investments. I think sometimes it's helpful to have people on the podcast like yourself who've already done deals, you're already making things happen. And I could tell just from our quick primer, you already know the lingo, you know the business, you got to put deals together. Can you just start off just by telling us a little bit about your story, where you got started, and what you're doing today?
Sure. So I got started actually 20 years ago. I started investing in stocks when I was 14 years old. Wish I poor dad kind of wanted to start investing. From there, I went to business school expecting to go the whole stock route, but then the markets crashed. I had to pivot, started working for the government. And once I started working for the government, I was looking for tax-friendly investments, stumbled onto real estate, bought my first single family rental, literally got my first paycheck. 2 weeks later, I was in contract to buy my first single family rental. I realized that it wasn't all that it was cracked up to be. I didn't want to scale. It was actually a Section 8 property. So I was managing it myself. I was doing the construction management. I realized I didn't want to scale that. So I went from there to more of the passive side. And that's where I stumbled onto a lot of these alternative investments. And then I did that for about 10 years. And then as I started technically retiring from my government job, I got more actively involved on some of the real estate projects. And then we started actually syndicating some of the deals that we were previously partners in as a limited partner, but we started transitioning over to more joint ventures. And then we finally actually became general partners on a lot of the deals that we invest in now. And then we ended up, due to some key relationships that we've developed over the last 5, 6 years, we zoned in on two specific niches in the multifamily space. It's affordable housing, which is Section 8 at scale, which is ironic because I really hated it when I first got started at it. And then it's hospitality. We live on the New Jersey shoreline coast, so there's tons of great hospitality properties that are 30, 40-year-old motels that are really out of date and they could really use a refresh. So those are the two segments that we've stumbled on, and we've built out property management companies for both segments. And yeah, that's us in a nutshell.
Awesome. I think your story is a bit unique because you noticed really quickly what you didn't like doing. And so you pivoted right away. I imagine that you made some money in the alternative space and then decided, okay, let's reinvest that money at scale. A lot of people find the multifamily hospitality world to be just better to scale because you've got all these units under one roof, more income to play with, more flexibility. Is that similar to what you found?
Yeah, you know what it is? I think at the end of the day, that's you could definitely look at it this way. The other way that what ended up happening is we ended up having these relationships with these partners that we were able, the larger deals allow us to leverage the skill sets of a larger team versus everything on me. So if I had 5 or 6 or 7 single family rentals, there's nothing wrong with that strategy, but 80 to 90% of that stuff will be on me, the day to day. And I work within our property management company. I oversee over 200 units and I oversee a specific state. But at the same time, I have people under me. I have a lot more delegation, and that suits my skill set a lot better than trying to have more control over a smaller portfolio, but have more responsibilities where I would inherently be doing things that I don't actually like doing and I'm probably not even good doing. Like hospitality is a perfect example. Like I shouldn't be responsible for branding and marketing. And the way that our hospitality division is broken up, I have zero to do with the branding and marketing. So that's where the larger projects allow for larger teams, which allow for skill set, actual application.
I think I have a question that somebody else might be asking is like, how do you find that team? How do you find those partners? I know everybody has their partner horror story. But how did you find these people? Where were they? And how did you know that they would be a right fit for you?
It's funny when you do a 30-second intro, like fast forward time. But in truth, like when I got my first single family and it was Section 8, that took a year or two to realize that wasn't right for me. It wasn't overnight. The same thing with partnerships. It's all about time. People try to force partnerships. It's almost like your partnership with your significant other. You can't propose after the first date type of situation. So it really takes a while to really get to know someone, know their skill sets, know what they're like. So that cannot be fast forwarded. It really takes my main partner in affordable housing. We, at one point, we were talking on a weekly basis for 2 hours a day. And we were talking about life. We were talking about his current deals. We were talking about what something like a partnership, even before the word partnership was ever used, like there was a genuine like friendship and genuine relationship first, and then the partnership came after that. And there were like small tests that I think we both were testing each other. For example, we took a road trip to North Carolina because there was a syndication that we both invested in, and they were doing like an open house where you could walk through the apartment building. And for an LP, that was pretty awesome. Like I never usually got that kind of access. So we connected during that road trip. And even little things like creating a Google sheet with all the expenses from that trip, like how much gas we spent, how much food we spent, blah, blah, blah. And then he actually kept track of everything. And then when we were done with the road trip, he sent me like, hey, your half was 190 bucks, blah, blah, blah. Like even actually caring about that stuff and like looking it over, seeing how he came up with that list, see what he deducted. Was it fair? Was he just freeloading? All of that stuff. And then I'm sure on the vice versa, he was testing me like how quickly did I pay that invoice? And did I argue back? Did I do this or this, whatever, blah, blah. So there were like little steps like that. So my advice is if you're going to partner with someone, understand that it's going to take a serious amount of time before you should actually be partnering with someone. And then second, understand that little activities that come across that initial like dating period, let's say, they mean a lot more than they look to the appearance.
Yeah, I could definitely see that. You're kind of dating and you're looking for signs that this might be the one, right? Or
Yeah.
this might be a good partner. So that's pretty cool. All right, so let's talk about the deals you're doing today. What's the bread and butter? What are you looking for in buy box?
Yeah, so we'll start with the affordable housing side. The affordable housing side, we look for 50 plus units. We are in the Northeast, so we look for things that are within 5 to 7 hours away from us. So either it's a 1 hour flight or it's a 5 to 7 hour car ride. Right now, we are in Ohio, Pennsylvania, and now we're doing acquisition in Virginia. So we're going to be in 3 states for the affordable housing division. Everything gets plugged right into our own property management company, which was 2 year undertaking to actually get that set up and running. So we do focus on affordable housing. What a lot of people don't understand is affordable housing can mean a wide range of different items. The way I like to describe it is if you have a raw piece of land, it's surprisingly similar to build a brand new Class A building and building affordable housing. So no developer would ever build affordable housing. So the way that they actually get around this is they offer LIHTC credits for these developers. And these credits basically subsidize the cost of these new constructions or these heavy remodels. and they basically last for two 15-year periods. And we like to come in and buy in the second 15-year period. So part of our buy box is the 50 plus units. It's within that geographic area, and it has to be within the second period of that compliance period, because what ends up happening is then it becomes a clear business plan where you know that once that second compliance period is over, you have a free market rate apartment building. Usually there's built-in appreciation as it gets closer to that end of that compliance period. You have a lot working for you if you have the team in place that can manage the compliance and the bureaucracy and all of that stuff that comes with affordable housing.
Yeah, I could see that. I've got some buddies that are they're really big in that live tech space in the Carolinas. I think they're seeing similar outcomes there. Okay, so like your deal flow right now or the lead flow that you get for those types of properties, are you responsible for that, or is that something that you've been able to partner up with somebody else to help bring in those leads?
Yeah, so the good thing is we're like firm believers of like slow and steady. So if we get a deal a year, we're pretty happy. Like right now, we're coming off of an acquisition that'll keep us busy on the affordable housing side for the next year or two. We have some broker relationships in the affordable housing space, but we also have some direct to developer relationships. Some of these developers don't like going with a broker because just because they get a high offer, if the buyer doesn't have affordable housing experience, the state won't approve that transaction. So
Hmm.
sometimes we do have some connections with actual developers that we do check if there's anything in our geographic area that they're interested in selling. We do have some broker relationships, but I would say in terms of acquisitions, we spend maybe 5 to 10% of our time on acquisition development and then 90% of the time on operations.
Yeah, yeah. Are you taking on new investors? Are you taking on new partners for your projects?
Partners probably at this point, very few. Like we have a lot of different business segments set up with hospitality. We have two partners, and then we have two partners on the affordable housing. We actually did bring in another equity partner for this Virginia deal so that they could exclusively oversee that one state. But usually we're very careful about adding partners because partners can 10x your business and then they could bring down your business pretty quickly.
Yeah.
So we are pretty careful of adding new partners, but in terms of investors, we do have certain, like for example, on our previous deal, we had this one week window where we gave our existing investors priority on the new deal, and they ended up taking like 80% of the deal. So I think going forward is we're trying to add the right type of investors. Like our projects are usually 10-year holds. So they're not your 2 to 3 year, you're gonna double your money type of deals. Like we're like slow and steady. Our typical buy box for returns is like 4 to 6% cash on cash, 13 to 15% IRR. But we're much the slow and steady type. So when we're talking to investors, we're not gonna like it's a bad fit if you're telling me like, oh, you could get a 20% IRR deal somewhere else or whatever it is, because then you're too focused on the returns. And honestly, like I've learned on a lot of my LP deals, it's the returns come after the relationships. If you have a good relationship with someone who is ethical, hardworking, doesn't put a lot of leverage on the deal, the returns will follow. However,
Absolutely.
if you're blinded by like heavy numbers and quick, hey, this is going to 2x in 5 years, you're probably not the right like investor for us. So we even with our deal size and our deal flow, we probably add a few investors a month type of thing, but we're not out there really trying to get hundreds and hundreds of investors our way because it just won't be a good fit long term.
Absolutely. It definitely sounds a lot different than a lot of the returns investors have come to expect over the last few years. But I also like the idea of slow and steady, predictable returns. And I'm sure that fits some people for sure. I also imagine that in today's environment, bit higher interest rates and some iffy kind of economic indicators, that your strategy of slow and steady and 10-year holds limits how impacted you are by the current environment. Would you say that you're not as worried about where rates are today or what pricing is today than somebody who is trying to get those aggressive returns?
Yeah, those aggressive returns come usually with variable loans. To me, it's unnecessary type of risks. Like from my stock days, Berkshire Hathaway, the legend, 16% annualized returns. It's not, he didn't get 20, 25% returns. So 13 to 15, if you could consistently do that, you're going to be a few percentage points from Berkshire's rate of returns, and you're in pretty good shape at that point. So I think you need to strip away a lot of those higher risk deals that everybody labels their deals conservative. But at the end of the day, you're
Yeah.
looking at the financing in place. You look at the fact that the business plan requires like these heavy turnovers in a CapEx environment where your CapEx is doubling, tripling. The way we do things, we usually put 10-year fixed debt on the property to match the 10-year holds. Maybe sometimes it'll be 7 years. But realistically speaking, we like that 7 to 10 year model. One of our mentors always taught us like commercial real estate can be incredibly forgiving as long as you can hold on to that property. And there's usually two ways you're not going to hold on to that property is A, not hitting your debt service, which would be a byproduct of getting a variable loan rate debt that skyrockets on you, and B, not having the right insurance and having an unforeseen event happening. So we've been very careful with those two things, and we know that if we hold it long enough, it's going to be fine. The other thing that's interesting about affordable housing and long-term holds is that the further away you are from the compliance period, the cheaper you can get that property. Like for example, we on our last deal, we're getting it for $36,000 a door. And the reason is because the compliance period ends in 2041. So it's a 17-year compliance period that it's an extended, it's even though it's in second 15-year period, they have an extended 10 years on top of that. But we're getting a great deal because we need to hold it for at least 10 years, which we were going to do anyway. And then in
Right.
10 years, the property is going to be that much closer to the end of its compliance period. So there's almost this built-in, we're getting a discount for doing a model that we would have done anyway.
Yeah, definitely. It seems like a no-brainer based on your expected hold time. So, talk me through a big thing that I think I'm taking away from this call is like really being clear in your strategy and the relationships that you build in your business. Can you talk me through a little bit like how you're meeting new people, if that's something that you are doing, how you're building those relationships that are necessary?
Yeah, so I'll start from the beginning. My network was zero at one point. I think the first thing that I think really helped me was being active someone on LinkedIn. Like one of the tips that I've learned early on was just change your name underneath your name, just put real estate investor or mobile home park investor or self-storage investor or flipper or hard money lender, whatever it is. Actually put that in the title because what's going to happen is there are virtual assistants out there that are specifically targeting and looking and searching for that specification. So when they see it, they'll reach out for a 15-minute call. Now, a lot of times that call is equivalent of someone coming to your house and trying to sell you windows. You're not going to get a lot out of it. However, they're going to use the right language. So if you put that mobile home park invest or whatever it is, they call you and you need to know what the difference between public utilities and private utilities are, or what a sewage pump is, or what all of that stuff. So getting on those conversations where it's really, yeah, you're getting sold 20, 30 minutes, but you get to hear the lingo for that 20, 30 minutes. So I think a
Yeah,
lot of people skip that step of actually educating themselves. They'll listen to a podcast and they'll say, okay, cool. I want to go from 10 single families to buying a 100-unit apartment building. What's my next step? Your next step is actually to learn the language of that 100-unit apartment building. So that's where I always say use LinkedIn as your first tool. Now, after you've gone through a couple of phone calls where you completely understand all the language that's being used, then you start going to local real estate meetups, conferences, all of that type of stuff. And then what you need to actually do is actually follow through with the people that you're meeting. Not everybody's going to be a good connection. That's a valuable skill in itself, is to actually be able to have a conversation at a local real estate meetup and being able to clearly from that 3 to 5 minute conversation, clearly say, hey, this person is going to be worthwhile to keep in touch. Or this person, he's going to be the person that's going to be here in 6 months still looking for his first deal. Like you have to make that assessment. And there's nothing wrong with having a few people that you try to help get their first deal, whatever it is. But at the end of the day, you can never force action on people. So getting to that point where you're at a meetup or a conference, getting to the point to realize, hey, this is someone I want to stay in touch. And then the last step is after you learn the language, after you've gone to conferences, after you've met a couple of people that you deem like, hey, this is going to be a good use of relationship time building. What I like to do is I like to get on a quarterly calendar call. and you put it in there, you put it as repeating. If something comes up, you guys can always change it last minute, whatever it is, or the week of. I like to, like on my Sundays, I like to just email the people I have my repeating calls with, be like, hey, does this time still work for you? And that's how you start building real relationships. And then once you have strategic relationships, then your strategy will present itself in a way. Because if I never met Anthony and I never created this relationship with Anthony, I would not be in affordable housing today. So there would be no point in me saying, like, from day one, saying, oh, this is how I want things to look. Instead, it's allow yourself to be in a position to create relationships. And then once you created these like five core relations, and you don't need 100 of them. Honestly, if you have five core relationships, and this goes for investing, this goes for hard money. If you're a hard money lender, network with five other hard money lenders, talk to them on a quarterly basis. If you're a small multifamily owner, network with five small multifamily owners, network with them on a quarterly basis. Eventually, you guys will be sharing a deal that's just too big for one of you guys to handle, but you can get a 20 unit together or 30 unit together, whatever the case is. But network with people that you've spent the time with, can get on a quarterly call, because that shows a commitment on their end as well, that they're willing to get on that quarterly call with you. And then your strategy will present itself over time.
Yeah, you're building a relationship over time. I love it. I love it. This is great. This is great. So, how can people get in touch with you if they do want to further their relationship with you? I know we connected on LinkedIn, so it really does work. How can people get in touch with you?
Yeah, best place is my website, sihcapitalgroup.com. Just click learn more. You'll get on our email list. But you could also email me directly. My first name is Denis, Denis with one N, at SIH Capital Group. Just send me an email and I'll be more than happy to start a conversation with you.
Yeah, I think that's a great way to get in touch with them. SIH Capital Group. Hey, also, I think I might have missed this, but every time you reach up to grab your hand, man, I see these guns on your arms, man. You look like you're taking care of yourself. Is that on purpose?
Yeah, 2024. So when I was still working for the government and I was just getting into the general partnership side, it was just and three kids. It was just I kept coming up with excuses not to put like my health in priority. I noticed it. I was in my 20s and 20s, like my teens and 20s, I was always super athletic, the whole nine yards. And then my 30s happened, always too busy type of philosophy. And now I've almost cleared my schedule. Like I don't start my meetings until a certain time. I started doing CrossFit. So my
Okay.
CrossFit comes first, and then it's like recovery time, and then I go heavy into meetings until I have to pick up the kids from school.
Yeah, so you're taking care of your health as number one priority.
Yeah, like it's my kids and my health and my wife all together. But too many people, they don't prioritize health enough, and then what's the point?
Absolutely. We're making things happen. Man, I really appreciate you, Dennis, jumping on here today, adding value to our audience. I know you didn't have to spend this time doing this, but I know I've gotten some out of it. I know that somebody listening has also got something out of this as well. If this has helped you, wherever you're listening to this podcast, take the time to leave a review, drop a comment, engage with the post. It helps more people hear the podcast. It helps more people hear Dennis's message today. It sounds like he's doing great work, and he's also asked that you connect with him, SIH Capital Group. So make that connection. He is on LinkedIn, so you're welcome to connect with him there as well. Hey, Dennis, you have any parting thoughts before we jump off today?
Yeah, I'll say if you connect with anybody on LinkedIn, please don't use like a generic like message that a virtual assistant would say. Like I've been super disappointed sometimes where I would connect with someone and they respond by A, asking me if I'm in real estate, like question mark, which is like extremely frustrating. And it's like, why did you connect with me if you didn't even read my profile? It would be something like, how can I provide service for you? It's so generic, you just don't respond to those. So just actually, if you're going to connect with someone on LinkedIn, just actually be specific, actually read the profile and reach out with a genuine connection request. That's it.
Yeah, I think that's a good thought for sure. Hey, awesome day, awesome start to the day for us. If you're listening to this, you don't know what time we record these. It's our start to the day here on Monday. We'd love to connect with anybody again that reaches out. So reach out to us at grabthemap@gmail.com if I can help you. Hey, don't just look at it, grab the map.